currency devaluation is something that financial experts, economists, historians have been talking about a lot lately, because it's something that's happening not just to the US dollar, but it's happening all across the world. And it's a result of having central banks in charge who print money beyond what they actually have and then tax future generations as a result of those debts, and also the interest payments on those debts. So one concrete example, because again we've become so attenuated to the idea of having this currency that we just assume is stable, we have to have comparisons to understand, oh, well, why do we perceive our currency as stable, and is it as stable as we think it is? So let's just take the example going back about 50 years to when the United States was taken off the gold standard. And that was when Nixon in the 1970s said, well, no longer is our currency going to be backed by gold. And that had to do with the fact that a lot of debts were denominated in gold, and different countries were saying, well, they were starting to get the idea, well, what if we just demand payment in gold? And it was figured at that time by people in the US government that, well, we don't have the amount of gold that is needed to pay them, so we're just going to say we're not doing that anymore. But the thing that happened was that the value of every dollar that an American had rapidly went down the drain. And the easiest way to understand that is if you look at the value of an ounce of gold in 1970, which was between $36 and $37. Now let's just take the concept of $36 or $37 and $36 or $37 in an ounce of gold, right? If you would have put, let's just take $36 buried in the ground in 1970, and then you would have buried 1 ounce of gold in the ground in 1970. What would you have now if you dug that up 50 years later? Well, you dug up the $36, provided it was still intact, you'd have $36. And if you dug up the ounce of gold, you'd have $1,670, $1,680. And we're talking about gold having taken a hit in the last 6 months. I mean, a year ago, especially in the last 2 to 3 years, you would have had points where that ounce of gold was up over $2,000. So you've got a range of basically low 1600s to low 2000s for 1 ounce of gold. Yet again, you dig up $36 from 1970, you dig up an ounce of gold. So I mean, where is that spread? I mean, that's absolutely incredible. Like, there's no way to even think, oh, I could get that kind of return in a stock, or I could get that kind of return in a real estate investment. I mean, that's absolutely insane. That's thousands of percent return on your investment. And it's not that that's such an amazing investment, it's that that's how much the value of fiat currencies has depreciated, has declined, has collapsed. So that's something that whenever you read or research about it, it's absolutely incredible the way that monetary policy of printing more money ends. It always ends in tears. It never works out, because when you take money out of the future that doesn't exist, it's got to be paid somehow, and it results in the devaluation of every unit of currency in circulation at a given moment.